Welcome along to another ETF Spotlight review. A special welcome to my subscribers and anybody else who is checking out the channel for the first time. Today we will be looking at VLC, which is the Vanguard MSCI Australian Large Companies Index ETF. So for investors comfortable with the bias inherent in this portfolio, VLC does an admirable job of providing cheap access to the top end of the market. The fund's top 5 names, which you can see here in the first slide: Commonwealth, CSL, Westpac, NAB, and BHP. Pretty much they comprise 45% of the assets held in the fund, and this is sort of something that investors need to be aware of and be happy with that type of risk, because this is a little bit more concentrated than the other more broader based ETFs. But this one, if you're looking for access to the larger end of town specifically, this is maybe one to look at. So hang around and check out the analysis. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, let's dive right in here and check out some of the particulars. So the Vanguard MSCI Australian Large Companies Index ETF seeks to track the performance of the MSCI Australia Shares Large Cap Index before consideration of fees and expenses and taxes and all that malarkey. So the ETF provides low-cost, diversified exposure to the largest companies and property trusts listed in the Australian Securities Exchange, the ASX. It offers potential long-term capital growth and also associated dividend income, and with that dividend income comes your franking credits. Why we bother with this one? Vanguard investment approach provides investors with an efficient way to capture long-term market performance. The fund invests in a diversified portfolio of securities, which means that the fund is less exposed to the performance fluctuations of individual securities. The fund has a low ongoing fee as Vanguard strives to minimize the cost of managing and operating the fund. So Vanguard is set up to actually work for the investors. As from memory, there's a different structure to most of these companies, and that's why a lot of people like it, because the fees are always quite low, and the Vanguard actually works for the investors, not for the owners. So VLC tracks the MSCI Australia Shares Large Cap Index, which aims to capture approximately the top 70% of the market's float adjusted total capitalization, implying only modest diversification benefits to the domestic equities allocation, and is thus more concentrated than the standard ETF tracking the S&P ASX 200 index. So it's more concentrated than, say, STW, IOZ, or A200. So that's something to keep in mind. Let's move on. Okay, let's have a closer look at some of the numbers. We had a net asset value of $60.77, trading just below that at $60.75. Market capitalization of $104.5 million, thereabouts. It's one of the bigger large cap index funds on the market. A very respectable management cost of 0.2% per year. You get money every quarter, January, April, July, October. The dividend yield has come down a little bit in the last 2 months, because the share price of pretty much all these ETFs are going up now as people realize that things might not actually be quite as bad in the market and the general economy as first thought with regards to coronavirus. So if you're looking, might be the time to have a look at some of these ETFs now. And with that, you look at the makeup of this ETF, as I sort of mentioned before. You've got concentration of banks, and the banks have sort of taken a bit of a hit recently, but they're sort of starting to claw back a bit of that now, and that's what I think is driving some of the price increases. These ETFs that track the ASX 200, ASX 300, all the sort of the larger cap type tracking ETFs. The banks are definitely on the way up. You get a dividend, about 5%, so that's coming down over the last couple of months. So the big companies packaged in this ETF are mature businesses. Some people might call them blue chips. Typically have strong cash flows, paying above average dividends and franking credits associated with your dividends. So before buying this ETF, you need to understand that it's highly concentrated, as we touched on before, which could increase your potential risk factors, just for the sheer fact that if the top 6 companies in the ETF go down, that's going to affect your overall performance quite heavily. But if you're comfortable with a high concentration portfolio, VLC does an admirable job of providing cheap access to the top end of the market, as we touched on before. If you are looking for some other alternatives, maybe have a look at ILC or SYF. You could use VLC as a core holding to build your ETF, or so your broader ETF growth and income portfolio around. As I mentioned, it's quite low cost, low turnover, which is good. That's another reason that the fees are quite low on this one. It's quite tax effective, and it's it gives you a reasonable representation as well. But like I sort of said, you do have that concentration in those top 5 or 6 companies. So if you do like this one, VLC, you might consider combining it with an international ETF, and that gives you a bit extra broader diversification of assets and risk. So you might buy VLC, and then you might buy IOO or something like that, or you might look at country specific ETF. You might look at NDQ, or maybe look at the ETFs that just focus on England, or you could look at one that focuses on China or something like that. But looking at something gives you a bit more diversification in your portfolio. So on the left hand side, we can see what I was saying about the concentration here. So CSL is almost 15% of the portfolio, Commonwealth Bank's almost 12, BHP is almost 10, Westpac, then you got Westpac, National Bank, ANZ, and they all make up, what's that, another 15-16%. So you can see that definitely is highly concentrated in those top half a dozen companies, and that's something to keep a broader take a broader view on, I should say. But I don't think it's necessarily a bad thing. You should get some decent dividends out of these companies over the longer term. So if you're getting above 5%, I think it's not a bad play to be in. Some of the other index ETFs that track the A2, that track the ASX 200, A200. The ETF A200 is getting about 4.3%, IOZ is getting about 4.89%, STW is probably the best of the A200 trackers at 4.2%, and VAS will pay you at the moment about 4.7%. So, I mean, if you're looking at pure dividends, I suppose this isn't, and you sort of want to broaden your risk profile, this isn't a bad one to look at. Since inception, you've been getting 6.09% per annum, which isn't too bad over time. So, you know, you got to sort of keep in mind that large companies in this ETF are typically mature businesses with strong cash flow, and therefore they have historically paid above average dividends and franking credits. Just because the stocks are perceived as blue chips, it does not actually make them immune to earnings and risk, valuation risk, I should say. And fundamentals apply across all market segments. So I think you still have to understand, this is obviously a heavily in financials, weighted towards financials and mining. A little bit of infrastructure. I mean, you can see Goodman Group there, so you've got some exposure to real estate and Transurban as well. So, the top 10, you got a pretty good cross section of the Australian economy, and you can take advantage of that. So it's not a bad play, I don't think, anyway. Something to consider if you're looking for something that's a little bit more concentrated and hopefully get some good capital growth over time, but also get some dividends. Because what you got to remember too is your dividends actually make up quite a lot of your return over the long term from your portfolio. So keep that in mind. Yeah, overall, this is definitely something to look at. If you're starting out, it might not be a bad option to start off with. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.